Hey everybody, Jared Jones. New data from Redfin shows rents are on the collapse. The correction is here. The deflation is among us. And here's the deal. Rents in January are only up 2% over year. So you are talking year-over-year growth of rents. If you look at them on a graph over the past year and a half, have just absolutely been ballooning out of control. We are now seeing them hitting towards a flat line, and the prices of rents are falling. From the peak of last year, rents are down right in the 6% range. Okay, so we had national Redfin all markets around 22, just inside of 2,100. It was like $2,050 a month in rents. Now it's down about $100 below that, and rents are coming down. Folks, when rents are falling like this, you can rest assured home prices are going in the same direction. And here's why I'm saying that. Buyers are gonna reward themselves with the best possible opportunity for housing. People are just not gonna choose to own their own home because, they get the fragrance, the aroma, the freedom of a new house that's theirs and all this. In the end, they're not gonna pay $500, $600 more a month to rent the same house. Folks, when rents are coming down, prices are gonna come down too. And you know this is true because we just saw the Case Shiller Index come back a week and a half ago. And as you know, Case Shiller is a great deal of data. It's a great data set, covers the country, but it's also very late. We're always looking at it in the rearview mirror. And we saw November come out about a week and a half ago, and it showed the market in price across all metro areas still correcting. Now, the interesting thing is, how much further will that go? Think back to the most recent index that we had come out for Case, and that data was lauded as one of the biggest extreme drops that we've seen since World War II. It said, Fortune.com was saying, hey, this is one of the largest changes in property price that we've seen in such a short amount of time, and it really didn't change much. We're now at the 4 to 5% range from the October release to November, okay? So from the peak in June, that index has fallen 4 to 5% from June to November. And again, I'm waiting for the statisticians to spin their creative storylines as far as how much velocity that price loss represents. But I can tell you this, when we look at Redfin's numbers now, you can see that those numbers are actually showing that the rents have fallen 6+% to this point, end of January, right? Keep in mind, imagine if we had the foresight of a Case Shiller Index in present day. I would imagine we're probably going to see price declines trailing just the same as they finish their index out, and we have more updates on that. The other thing that's really interesting is in January, the Mortgage Banker Association were reporting that the slump in refinances took off in January. So the lack of refinances were really just kind of struggling. They were off 70, 80% coming to the end of the year. We are now at the highest point of application volume from January than at any point we've seen since September of last year. People are refinancing again. Believe it or not. You think about this, folks. How in the world are we seeing refinances when the 30-year going rate is 6.5%? Most of these folks that are now applying for refinances have 3% interest rates. Okay, or better. These people have low interest rate. Why are they doing it? There's cash out. Cash out is the main reason you're going to refinance, only reason you can refinance to a higher rate. So folks are taking a new higher rate, bringing the cash out. Why would you do that? Well, maybe you think that your home is probably not going to be worth more than it is now. If you might as well tap that ATM, let's go get it. I can't think of many good reasons. And honestly, I don't think this spells any good news for housing. For people to be tapping into their house equity at a higher interest rate at this point. It's not like we think that we're gonna be back at 3% interest rates by the end of the year so we can try this now and refinance back out of it in a few short months. Not the case. But if you are reading all the headlines, cash-strapped consumers are maxing credit cards out in epic fashion. The amount of longer-term non-paid consumer rolling credit is getting higher. So people that used to pay their credit cards off in a single month, not happening anymore. When you look at credit card interest rates now going 20 to 25, 27%, is a 6% cash out refinance all that bad? But here's the deal, folks. When people are cash out refinancing, in a lot of instances, it's to ward off challenges from a financial standpoint, okay? These are not the ideal. You can't paint a picture that borrowing out all this money at a higher interest rate at these terms in the market we're in right now makes a ton of sense. But these people are trying to avoid putting their house on the market. They want to get the cash out right because you could sell the house. But I mean, heck, if I need to sell, but I need the money, I'm going to cash out first. And honestly, folks, I think this is the last of few ominous signs that we're going to see before you start to really see more and more inventory pushed in the market. I think a lot of sellers have just been holding off. They're doing anything they can in order to stave off trying times. We'll see what happens as the year unfolds. But that's it for now. Let me know in the comments what you think is really behind these headlines. And as always, please smash that like button, subscribe to the channel for great updates, and we'll talk to you real soon.